Emergency investor warning. Portfolio Builder's high risk, high return strategy is now up 280% in 2021. And we may need to lock in gains in the next few weeks. A lot of very important information to cover in today's webinar. Let's take a quick look at our returns in the 4 strategies Portfolio Builder publishes up to date on October 19th. Our high risk, high return portfolio is up 20% in October. This is a big bet on Ethereum. We have a huge inflation hedge with NRGU, or the oil and gas play. We're betting on high demand for lithium cobalt from tech giants with REMX, and we're hedged against the stock crash with UVXY. Beautiful portfolio, and what we're giving away to free trials if you're just now taking a look at our program. Now, if you upgrade, you're going to get 3 other strategies. Safe Alpha is very similar to Warren Buffett's Berkshire Hathaway in its composition. Big tech play, big value play. It's doing incredibly well, up 14% in the month of October. If you're a big fan of Ray Dalio and you want to be as diversified and safe as humanly possible, go with our global strategy with Safe Growth Pro, up 12% in October. It's actually closer to 13 right now. And then if you want a hybrid of the Pro and Safe Alpha, taking advantage of big objectives of the government, go along the Bootcamp core portfolio, big Bitcoin position. We got solar panels. We've got exposure to the medical marijuana space and even uranium. So a lot of really interesting plays, some exposure to Chinese tech, Alibaba, up 17% in October. Now, year to date, the high risk, high return portfolio is up 280%, outperforming the S&P 500 18 times. So right now, the trade alert is buy. This exact setup in all 4 strategies is poised to rocket ship higher as the dollar falls and the probability of stimulus passing gains as we get closer to the next big catalyst date, which will be December 4th. So buy, trade alert, but be ready to get defensive as some of these risks become a greater threat as we approach the end of November. So we're going to highlight what those threats are. Now, you really don't want to get cut out of our trade alert updates. So call Dean at 505-610-1334. He's going to walk you through the trading plan, give you a special deal to get access to all our portfolios, webinars, and the ever so important risk calculator in our membership area, where you can type in exactly how much money you want to invest, and it will print out exactly which ETFs to buy and how many of each to follow our program perfectly. And if you're catching this as an advertisement on YouTube, realize you will not see the very end of this video, where we reveal the exact asset allocation per strategy. So let's go ahead and jump into it. I'll do a quick shout out to the live crowd. Live calling in, we have Jeff Friedman, we have a 2412, A. Tafor, Anton, Bob, Chang, Chuck, Clint, David, Ed, Eddie, Eileen, Eric, Gary Barber, George, Harry, Iron Man, Jan, J. Vaden, JBWH, Jeff Rep, Jenny, Jody, Nell, Kurt, Orlando, Martin, Michael, Mongo, Morris, Murray, Neil, Oscar, Pat, Peter, Robert, Ron, Sam, McDaniel, Sean, Tom Sharp, Stephen, a couple Stevens out there. So hi to all 4 Stevens, Terry, Van, Vestura, Victor, Wayne, and Wendy. So very, very good. Post your questions in the chat box. I'll get to those as soon as we can. But the fear I had is proving out. The medicine being deployed to fight the sickness that's locked down countries globally for over a year now is absolutely, without question, not working after about 90 to 120 days. And so a handful of countries that are highly medicated are seeing the same exact pattern we saw in Israel just a few months ago. So right now, the 2 places you want to be paying close attention to, I'll give you 3. are the United Kingdom, definitely having big problems. Then Singapore, and then I'm looking at a specific state in the US, Vermont. So we can see UK has record cases growing, record amounts of deaths. And the data is showing that if you are taking the medicine and you're over the age of 18, your probability of contracting the sickness is as little as 50% higher and as high as 100% higher, depending on the age group bracket. So we'll talk about what this means, timeline for the United States, and how it matches up perfectly to the budget or the reconciliation bill. Here's a look at the cases in the UK. So very, very interesting. They completed their second dose in July and then reopened. And now we're starting to see what you wouldn't want to see based on that data. Here's Vermont. This is the most medicined state in the US. And as you can see, hitting record numbers of cases. And then Singapore. Okay, so same chart. Now, if you were to pull up a list of all the most medicined countries in the world, you wouldn't see spiking cases in all of them currently. So there's still a lot of seasonality as to when this spreads, and that probably is due to patterns with human traffic in terms of getting into small closed areas, and then temperature. So those are the two main things we're seeing. In general, the US is trailing data out of Europe by about 8 to 16 weeks. Now, here's the big trend for US, and specifically when I'm anticipating we're going to see problems in the hospitals in the US. Mainly the very last week of November and all of December. So this happens to be when we're going to hit the next debt ceiling. And so very likely, if we don't see the reconciliation bill get passed by mid-November, or perhaps the third week of November, we will have the likelihood of hospitals being overwhelmed, probably a lot of blame on the people who are not taking the medicine, getting the people who took it sick. I could see that being the narrative. We could see lockdowns helping create a market crisis and really pressure this legislature, because they really do need to get it through by December 4th, or we're back to the same problem we had during the last sell-off due to the debt ceiling. So we'll see how this plays out, obviously keeping a very close eye on it. Until we get very close to the end of November, I'm anticipating all our positions melt up higher. So I'm not saying to make any changes right now, but we're giving you a heads up as to what to expect. So by late November, the USA will likely be facing the exact same problem that Israel had, and is at risk of a new lockdown, which could be politically motivated, which is really important. A politically motivated lockdown to pressure Joe Manchin and Jayapal to agree to a massive Build Back Better stimulus spending plan. What's in this plan is highly inflationary and beautiful for the way we're positioned. I do believe it gets passed one way or another. Either the pressures in the market cause this to occur, which again would back up our anticipation that there could be a lockdown and a market crash if these guys won't come together and agree to reconciliation bill. So we're going to be paying very, very close attention to this. The deadline is December 4th. Now, a lot of analysts like Goldman Sachs are actually predicting this may not get passed till mid-December, which would lead me to believe that we would have some extreme market volatility if it really is past mid-December. So again, we got to pay very, very close to this. My prediction is the market melts up until mid to late November. Then, without good news on the new stimulus, the market begins a meltdown. So that's what we're going to be looking at. Now, I do want to review some of our predictions that we gave out on October 12th, see how those are faring. First of all, I bet that the CPI will fall slightly Wednesday. It traded flat, so it didn't go up, it didn't go down. It was 4.02 months in a row. I actually believe it will rise next month because now we're going to have rent and energy starting to affect the CPI. I am confident we're going to have very weak job growth in October, which may delay at least 1 month the Fed announcing official plans to begin tapering. And Powell will not have the October labor data when he has to make the decision November 3rd. And no, don't buy BITO, the Bitcoin ETF. No changes. We're good to go. We don't want to trade the futures product. It will dramatically underperform GBTC. So, okay, CPI came in flat at 4, so we did good at projecting it wouldn't at least rise. Market was surprised. Retail sales actually went up 0.7%. That was a big headline. Now, will the Fed taper and or will they let inflation run hot? That's going to be the big news November 3rd. I'll probably add a little bit to our UVXY position towards the end of October, and then be ready to get much more defensive towards the end of November, assuming we can't pass stimulus. Now, if the Fed tapers November 3rd before it has the jobs data, it could cause either stock volatility or bond volatility. My bet is that initially it would create bond volatility and a growth to value rotation, because with less buying of bonds by the Federal Reserve, in general, we'd expect the interest rates to rise until they caused pain to markets. And I think they need to rise considerably before they're going to cause pain. So prediction 3 since October 12th was that stocks, crypto, and commodities would melt up higher until we get closer to December if labor growth is weak. And again, this is all playing out to the tune currently. So we've been very accurate so far. I believe Jayapal and Manchin will agree to a $2 trillion stimulus and that it will be done before mid-December. If it's now, it needs to happen before that to avoid a volatility event, in my opinion, which is why we will hedge up as we get closer to November if there's not good news. Next prediction, Bitcoin hits 100K and oil over 100 by March of 2022, and that this is going to be rough for tech companies, that they either trade flat or fall, while you see products like NRGU skyrocket up to oil going up. And we may hit that target by December. When we look at the energy crisis spiraling out of control globally from China to Europe, boy, oh boy, that $100 oil price may happen sooner than we all anticipated. Now, we will review the asset allocation breakdown and detailed monthly profit loss breakdown at the very end of this video for each strategy, for paid members and people who are in an active free trial. If you're expired or catching this replay on YouTube, you will be cut off before you get that access. So write this number down, give Dean a call, 505-610-1334. Okay, great. So I'm going to take a quick look at the chat questions coming in before we jump into key market risks. Michael's joking about what great knowledge are you going to impart on us? Great sage. Ed says, how should we position for November 3rd? Should we pare back our growth positions? And then Michael is asking if we want to do BITO. No, so yeah, I don't like the futures ETF. I do like GBTC. So we'll talk about that. GBTC is trading at a 20% discount compared to its books, and if the ETH is trading at a 10% discount. And everyone wants to know when to get long bonds. Yeah, so I think we have, I believe tapering will create interest rates rising initially. So we're really positioned for that. The tapering event may just be perfect for the way we're currently positioned. It's once those interest rates become too attractive that I would believe they would create a stock crash. And it's the failure of stimulus that is the prominent risk to markets, which I don't think we should worry about till later in November. Okay, so let's look at some key market risks. There are 7 million Americans who lost unemployment benefits in the last 3 weeks The big question is, will they return to the workforce in October? So far, they just don't want to go back to work. This is mind-boggling. A lot of people thought once the benefits and fruit punch bowl was removed, they would all rush back to work. It's just not happening. And mandates are causing lots of problems in the economy. One big highlight is the TSA group for airlines. 40% are refusing the mandate. And the deadline is right before Thanksgiving. So the airlines could be in complete disarray. And then the bulk of the government mandates occur right before Christmas. And then you add to that the problems with getting the ships to drop off the goods, with them just lined up off the coast of California. So just a lot of risks building up, and the market keeps melting up. So we really need the right pin to pop this bubble, which I believe would be the only thing that would pull it off. Would likely be stimulus not passing. We are seeing a record number of people quit jobs rather than take up a job, as they want to work from home and get a huge pay raise. So will this dynamic change now that there's 7 million people losing benefits and 10.5 million jobs open? That is yet to be seen. The call in sick movement is spreading. This could also disrupt supply chains and implode corporate earnings. So we're seeing the perfect storm develop here. But again, the main thing to focus on is Jayapal Manchin having a showdown on the reconciliation bill, which would be the largest spending package ever approved in American history. Just massive, massive, massive. And the economy needs it. Even with this, I'm skeptical it will keep the economy improving for longer than 3 to 6 months without robust labor recovery, which again, is not necessarily happening currently. All right, so we have looked at the trend we're anticipating, which could be used for a political weapon based on seasonality and the waning effect of the medicine. So from my perspective, I can see big pharma pushing that, hey, you got to go get your third medicine dose. Big money for those folks. If we see states locked down and then blame the folks who are not taking the medicine, getting the folks who did take it for getting sick, helps with the current administration's push to get, now they want 90% acceptance. And then simultaneously, this could crash and freak out markets and help push a budget through. So you can see how this is all adding up. Now, if the budget passes, I think we just melt all the way up till March. So that's why we're not making changes right now. I do believe the September sell-off was only a prelude to a larger potential crash by December if the debt ceiling and new spending continue to be blocked. So we have to just watch carefully and see when this plays out. Failure to close a deal by December. I thought they would have a little extra room, but I have been talking to some insiders in the Democratic Party here locally, and really the deadline's December 4th, so we do need to move up that timeline slightly. UVXY will be your best friend if we get a crash, and it could go up over 1,000%. Here's a look at it last March. Market's way more leveraged today than it was back then. And so we have the perfect recipe for volatility as we get closer to December. So we will prepare to increase the hedging towards the end of October and probably on the third week of November is what I'm thinking right now. Meanwhile, bad news out of China keeps pouring in, but Chinese imports and exports are at record highs. So we're still saying buy the dip. We're seeing some really nice returns on our emerging markets position today. Charlie Munger, Buffett's partner, doubled down on Alibaba, which we already have a lot of exposure to with the ETF EDC, which is 3 times emerging markets, and FNGU, which is in our Pro strategy, has 10 giant US tech companies that get the bulk of the call option volume, and then 2 Chinese giants, which are Alibaba and Baidu. Now, I prefer Tencent over Baidu all day, and you only get 10 cent with EDC. So a little bit different composure. EDC is only a third China. You get some of the other big countries that are growing rapidly out there, like South Korea and India, to name the two most important. So it's good to have a little combo of both of those if you want the most diversification. Now, it would be ironic for China to crash global financial markets in an effort to clean their economy on the back of their best year economically in history. And that could be their plan. That could be the plan. So I'm keeping a close eye on it. Currently, they are deflating their real estate market, which was extremely over leveraged. The big goal for China, in my opinion, is to make their currency a globally traded currency and remove all the capital flow restrictions. So before they can do that, and why do they want to do that? So they can open up a bond market like the US, Europe, and Japan have, and that way they can borrow trillions of dollars to financialize and put them in the lead. But you can't have a bond market without a freely trading currency, and you can't make your currency trade freely if everybody wants to get out of Dodge the second you did that. So they're bursting all these different bubbles in their economy to clean up the underlying assets in China before that happens. So what they're doing makes a lot of sense. I don't see them wanting to collapse global economies. Chinese real estate bond defaults continue to hit headlines. Now the CCP is cracking down on its own banking sector. And there's some funny info about energy crisis in China as well. So we'll take a look at that. But the big question is, when will their smash and grab by the Chinese Communist Party end? Okay, some lines in the sand that we had marked and we've since gone way away from. DXY is a easy ticker to track. That's the dollar against the euro and a basket of other foreign currencies. If that goes over 94.50, we would get very worried about the way we're positioned. It has since fallen, which it did hit 94.55 just a few days ago. Currently, it is at 93.5. And as I said, expect big gains as the dollar falls for the way we're positioned. So we've seen just that, huge gains, because we're betting on a weak dollar currently. Emerging market trading below 48 would be a huge red line in the sand for us. And we were approaching that. It's jumped since then to 52.45. TLT crashing would mean interest rates are rising. That would be a huge problem, currently at 43.93, so nowhere near that level. Brent oil crashing to 75 would tell us there's a real crash, a recession, a deflationary shock working its way through the world. Not even close today. Oil continues to march higher at 84.41 on Brent oil. Yeah, and then if China was really up to something sneaky, we would expect either their stock market to crash, which it's not, it's rebounding. We'd expect commodities to crash. It's not, it's just rocketing higher, as well as their coal futures just hitting these extreme highs. Imports, exports, record levels. Ports are stuffed with Chinese goods, and their currency remains super strong at 6.3. So no alarms going off to change position right now. Stay strong and let the profits rocket ship in here. So these are the screenshots when we said the warning signs. Again, we've now seen DXY fall since saying there's very little chance this goes any higher. Here's where we were at on emerging markets. It's jumped up to 52.50. TLT has traded flat. And again, the Chinese currencies stayed flat as well. And Brent oil, since we took these screenshots and lines in the sand, is again up slightly. So if a true recession is coming, and not just mere market manipulations due to politics, we'd expect oil and other energy commodities to fall. We'd expect bond yields to fall and the dollar to rise. Okay, so we really want to see all three dominoes fall in tandem to believe a deflationary shock is coming. Oil falls, dollar rises, and bond yields fall. So TLT is going up. That would really tell us something bad's coming. And again, we're getting the exact opposite. We've got yields rising, energy rising, and the dollar's now falling. So this is exactly what we're set up for. And again, rather, energy is roaring to unsustainable prices due to high demand. So again, watch for a sudden crash in oil prices to predict a deflationary spike. If you want to really simplify it, that'd be the one single thing I'd be watching. Now, we have seen shipping prices and times remain at record levels, but they have cooled off and pulled back just a little bit. So we're seeing a little bit of easing in that front. In general, what I see is a slow but steady reboot of global economies as the sickness slowly becomes less and less of a burden on society. I believe that likely this winter should be the last true health problem for global economies, and that the majority of the population will have a natural immunity. Now, if the medicine is blocking your body from having the full, robust immune response, which it does actually seem it's doing, then we're going to need to see these booster medicines being dosed out every 6 months at a minimum. Otherwise, this could continue to linger on and on and on. So we'll have a lot more data to evaluate that by March after we get through this winter season. Okay, core prediction remains that we have a slow motion multi-year rotation out of growth and into value. The big catalyst for this will be stimulus passing, and it will pass even if they have to crash everything to get it through. The stimulus will pass. So it's really just a matter of when. And I believe it will pass before the end of the year, one way or another, either easily or the hard way. So that's really what we should anticipate. 3 to 5 year bull market in energy companies minimum. We'll look at the trends for that. Could be up to 7 years based on the last few trends. And if we want to get to carbon neutrality, you know, Biden's talking about getting us to clean energy by 2035, and that we're going to have 0 carbon emissions by 2050. Well, that's going to be extremely challenging. And so we want to be betting big on our REMX, our COPX, which we're not in currently. The uranium ETF is going to be probably the only way this is all realistic. TAN is a great play for the solar. And so those are the other alternative investments. As soon as we think oil's just gotten outrageous, probably we want to dump oil related investments as soon as we break 120 and realize that it's going to be highly unsustainable interest rates and energy inflation that the economy can't handle as we approach that level. So 120 to 170, I think, is the absolute maximum the economy is going to be able to handle before we get a crash from that. So I'll also be looking at the price of ExxonMobil. Once it breaks into new highs, and I do think it will break into a new high, that'll be a good time to stop being so greedy on NRGU and take some profits. So that could put NRGU in the $500 to $800 range, currently at 200, just to put some perspective into this. Okay, XLE is the energy ETF. And let's just look at the last few cycles. So dot-com bubble burst. The government actually tried to reduce the spending in 2001, created a 2-year stock crash. Never, ever did they do that policy again. And that cycle, we bottomed out by 2003 and hit a peak as interest rates crashed the housing market by 2008. So you got a 5-year cycle that time. How did the government respond? Bail out the banks, suppress interest rates, and double the deficit spending. And that's been really the protocol, is to double the deficit spending each crash and suppress interest rates lower and lower, which makes the inflation get worse and worse. So the next cycle actually was a 7-year cycle, and you had this massive 300% return in XLE. Now remember, NRGU is 3 times the return of XLE. So far we've only seen about 1/3 of the potential move ahead based on the last 2 cycles in terms of the total return. And the money printing happening now is just blowing to smithereens anything we've ever done in history previously. Now, raising interest rates and doing quantitative tightening is not good for energy companies. And you can see when Trump went into office, that's exactly what they started doing right away. You could ask yourselves why, but you can see what happened to XLE. So we really don't want to see quantitative tightening or raising of interest rates aggressively when we're long these energy companies. I don't think they're going to do anything aggressive till 2023 after the primaries, because it would crash the economy, make it very hard for Democrats to have a chance at the House or Senate. So it's a very important political date to really focus on. Now, when stimulus passes, I'd expect EDC and EFO to outperform UPRO. So UPRO is the S&P 500 times 3, EDC is emerging markets times 3, and EFO is Europe plus Japan times 2. With our pro strategy, we get you exposed to all 3, and I do think it's time to take a little profit off of the S&P 500 once it breaks into a new high, and rotate some of that into EDC before the stimulus passes. So that could be a trade alert coming up soon. Here's a look at the last 2 times we passed stimulus. So you can see emerging markets went up 30%, European markets, and that's Asia, went up 24, and US only went up 19. And that's because US imports much of its goods and services. So the more money we print at the government level, the better it is for foreign continents. And that's why our pro strategies positioned for that to come through in the next few weeks. The other big thing that happened last time stimulus passed, which makes a lot of sense, our interest rates begin to rise. And you get that growth to value rotation. Now, here's how we're protecting you against that and a review of what happened. Yellow line are rates rising as we pass the 2 rounds of stimulus. We got interest rates rising all the way till mid-March. We saw the rates rise so quickly, it really knocked the wind out of tech stocks. Bitcoin actually took a big hit. And then in green, XLE went rocketing up. The problem was we didn't have policies to restore labor markets. And so those interest rates came crashing back down, and this whole trend reversed for much of the year. But now we're on the verge of passing the largest spending package in US history. And I promise you there's going to be more. They're going to need more to avoid a massive fiscal cliff or a rate of change that's highly negative from the government spending money. So this will likely get us through at least the first quarter of 2022, maybe the first 2 quarters. After that, you need more stimulus, or you need 1 million jobs a month coming online pronto. So that's what we're going to be focusing on in terms of predicting these rates. So if you're new, right now may be the best time for a huge profit to follow any one of our strategies. And if the Democrats get their act together and pass a big budget, we're going to touch almost nothing in all 4 portfolios and see these scream higher until at least March. Our only worry is if they can't pass a budget, probably by the 3rd week of November. If that's the case, I've got your back. I'll show you the exact trade alert to hedge yourself and be prepared for volatility. At the end of the day, this is not going to be a big crash that lasts a long time if they fail to pass stimulus, probably a month at most before everybody freaks out and they push this through the Senate. So I think there's a risk of a very short-term volatility event at best, and the likelihood of a 2008 or a dot-com like 1-year, 2-year crash is 0, because again, Democrats control all 3 branches of government. To believe they are going to destroy their chances at midterms by not passing stimulus and causing a depression in the economy is really, I believe, highly, highly, highly improbable. Okay, great. So that does get us through the intro. Let's go ahead and look at some data. Okay, so we'll start off looking at the boring old yield curve. Okay, so what's the yield curve? This is the interest rate paid by the US government to bondholders at different durations. And so what do we see here? In general, what I would note is that uh, huge demand driving rates near zero on the very short duration debt instruments. So up to 1 year, the rates are close to zero. So banks who like these products because it creates risk-free interest to pay depositors, they need it. They need a safe way to make good on the interest they owe deposits, which they have record levels of cash deposited in banks currently. But after that, the banks aren't so happy, and you can see those rates really jump. And that's because the official inflation at the very lowest print with CPI is at 4, and so these rates should be at least at the level of inflation. So either the inflation's transitory and comes right back down, and this 2% rate on the 30-year makes sense, or the inflation's not so transitory and those interest rates are going to go significantly higher, which is what I believe will happen. So that's what we're looking at. Now, if we start to see the yield curve essentially flatten or invert, that can mean different problems. So if we see that you make more money lending the US government at a short time frame versus a long time frame, that's highly problematic. So we're not seeing that currently. Now, as this yield curve shape changes, I'll try to give you a little lesson on it. But in general, we're seeing huge demand for short-term debt because there's massive amounts of money parked in banks. And I see this extremely bullish for how we're currently positioned. Okay, next chart, we're looking at the VIX futures term structure. So every month there's different VIX futures, and we're basically interested in how high the price jumps from month to month. The bigger the price jump, the more people are betting there's going to be volatility. So right now we can see primarily the risk is from now to November with a jump of 13.35. Then from November to December, it reduces to 2. And then from December to January, it gets even smaller. So the biggest risks are from now till December, which makes a lot of sense. Now, some people seem to think the tapering November 3rd could be a volatility event. So we'll just see how that plays out. I believe they will delay it to December based on no package getting solved by the Democrats. We got Schumer saying they're going to do it by the end of October. I believe there's not a chance that occurs. And then to make the call November 3rd before we see labor data in October, in the face of people getting laid off in masses and supply chain issues, I just don't see it. I don't think we're going to taper November 3rd. So we might do a tiny increase in UVXY ahead of the November 3rd announcement, but I do think we want to load the boat by the 3rd week of November if there's not a package through by then. Okay, reverse repo is a great way to see whether or not there's demand for US debt. If there is demand for US debt, that's highly bullish, means rates will remain low and make it an unattractive investment for anyone outside of a bank who needs the interest to pay depositors the interest they promised them. So it's at 1.47 trillion. This is also going to be our best indicator for when to dump our tech stocks. So once this falls to 750 billion, I'll likely reduce exposure to tech. But that's just not happening right now. So we'll keep a close eye on it. This is the reverse repo. Again, that means banks are not happy with the interest on bonds in the open market, which are super low, and they prefer to get them from the Fed at a better rate. So when our central bank is doing what's called quantitative easing, they're taking a lot of the bonds out of the market. and that's keeping those rates lower. And so that's what makes bonds an unattractive investment. So bottom line, as soon as that falls below 750 billion, it will likely trigger a trade alert to reduce exposure to tech in our portfolios. I don't think that's probably going to happen until stimulus passes and we've started to issue a lot of debt. So it could be February, March before that actually occurs. We'll keep a close eye on it. Okay, one of our biggest positions in all portfolios is NRGU. You can see the markets are predicting there will be a deal. We've got rates rising in gray. We've got the energy companies skyrocketing. And even the tech companies are not upset right now. They're bouncing right back up towards all-time highs. So it's what the tech companies really don't like is not necessarily interest rates rising. It's when they rise rapidly. That's what we've seen some volatility come from. So we'll keep a close eye on that as we get closer to passing stimulus. If we zoom out a little bit back to March, so we can see last time we did stimulus, you get this rocket ship in NRGU, rates rise, and then eventually it caused tech to sell off. And then we didn't actually recover anything in the economy. Rates began to fall, energy began to fall. We had all sorts of lockdowns across Asia due to the second, well, whatever wave it was. And the tech companies loved it. So what comes next? I think quite clearly, more stimulus comes, rates rise, and growth to value rotation. And it's already starting to happen. So you can already see that starting to play out right now. Okay, IWM is a great way to predict the future of the markets. Not giving us a clear signal yet, so it's been trading flat since January. Very interesting. So nothing to forecast there outside of it's been trading flat and looks like it's getting ready to break out higher. Okay, there's that emerging markets, which has been punished due to lockdowns throughout Asia due to low, well, potentially due to low rates of medicine. And then China just popping bubble after bubble to hopefully improve the long-term sustainability of their economy and society, at least at the way the Chinese Communist Party wants to run their country. And then Europe loaded up with retail banks, really positioned for the inflation play. So I love that position in our portfolio. Jeffrey Gundlach's been adding to this and talking about it vocally. So Ray Dalio is the huge emerging markets fan. We're actually seeing Buffett start to dabble in some of these Asian countries. And now Jeffrey Gundlach's really been an advocate of Europe. So we've got all of those covered for you. Now we're looking at Ethereum versus Bitcoin. In general, what tends to happen is Bitcoin, the largest market cap, jumps first, then Ethereum comes in second and outperforms, and then the altcoins come in third. And so we're seeing that trend right now. You can see Bitcoin up 55 with Ethereum up 29. And what's neat about GBTC is it trades at 20% below the assets it holds. So it's at a discount. They're applying for a ETF. And so you could potentially get a 20% better return on GBTC than you can on Bitcoin if you buy it and wait for the Ethereum, excuse me, the Bitcoin ETF to get approved. Now, ETHE is trading at a 9% discount. So both of them give you our two favorite crypto plays at a relative discount. Now, the big question is, can they close that discount window? And I do believe the conversion to an ETF would do the trick. So keeping a close eye on that. But yeah, that's what's playing out right now. We're seeing that outperformance. And since the 29th, wow, we can see a 28% return from this low, we can see a 46% return in GBTC and only a 31% in ETHE. So core has a huge Bitcoin position, high risk has a huge Ethereum position. Okay, we're starting to get a little bit on silver and gold today. So Peter Schiff's happy. Let's see, AGQ is up 21% since 29th. UGL gold is up 5%. These are leveraged spot products. Central banks continue to hoard gold. So I think in the long run, these will play off nicely, but they're just not nearly as exciting as what we're getting out of the cryptocurrencies. But yeah, they're much more old school and probably safer if you want less volatility. Just they've just been duds compared to crypto for over a year now. And we actually were lucky to dump most of our gold during this run up. Surprising to me how poorly it's performed, but maybe it's getting ready to have a better performance here. So keeping a close eye on it. We have a small silver position in Pro and a relatively small position in gold in Safe Alpha. Outside of that, we don't hold any other positions there. Okay, UVXY getting hammered lower. We're looking at defensive plays now. This will be your best friend if we get a crash. It'll be your worst friend if we have a recovery. There's that extreme return right here that you can see last March. That's where you can hit a huge win. It's an insurance policy. It decays at 2% a week. And you're not trying to get rich from it. You're trying to offset losses on your offense, on your inflationary plays. TMF would do really well if the government's going to hit its debt ceiling and have a prolonged fight over the deficit, and the dollar would do well in that circumstance as well. The problem is it's likely the stimulus will pass and all three of these continue to get beat down. So if we do transition into any of these three plays as we approach the end of November, it'll be for a very short period. And the second we hear that the stimulus is coming through, we want to get out. Okay, some of our alternative plays, primarily in the Bootcamp core product, are uranium, which we are not in right now. I'm waiting for a little pullback to rotate some capital into that. Great play for the next several decades. FNGU starting to really shine. That's the tech giants with a bit of Chinese exposure. TAN, the solar panels. Again, a lot of these were just getting beat all summer, except for a few, the uranium and the RMX. But TAN and MJ have just been beaten up. They're starting to get some love. MJ up quite a bit this morning. If we zoom in here on these plays in the short term, we can see FNGU up 24%. The URA uranium play up 22. We're not in it. We need to get into it. Should have pulled the trigger sooner. It's just been skyrocketing all year. And we got Bill Gates pumping it now. TAN making a recovery. That's solar. REMX is lithium, cobalt, rare earth metals. I should add in COPEX. That's another alternative energy play, infrastructure play. And then MJ trading flat, but a good jump today. The stimulus package could benefit MJ, so I may wait till that passes to see if we get a big pump in the MJ space through the reconciliation bill helping it out. Okay, so that's a look at our alternative plays in the Bootcamp core, almost completely related to energy or inflation, and have a government aspect where the government's printing money and pumping it into that industry. Okay, dollar index, here we're looking at DXY falling. Just watch your energy, you explode higher as the stimulus passes, the dollar falls. That's what I think is going to happen here. And Bitcoin as well takes off to the horse races. But yeah, probably we would want to get scared if this hits 90. I don't think it's going to go below 90. And that could probably be timing when to take profits in NRGU and Bitcoin, at least in the short term for next year. So we'll wait for this to fall back to this level, to the 90 to 89 level. Okay, China's currency is strengthening. No signs of weakness in China, despite all the defaults they're allowing to occur. We did review energy. In the crypto world, for portfolio builder, we only play Bitcoin and Ethereum. If you go to our private equity offering, which is only available to portfolio builder members, we're going to hedge you mainly for Ethereum. I'd say Ethereum's a good hedge if you hold Bitcoin. And I'd say if you hold Ethereum, you should absolutely hedge that risk by being long Cardano, Solana, and Polkadot. I also am a big fan of Polygon, a bridge between Binance and Ethereum, and also a layer 2 solution for Ethereum, which they may not need as much with the proof of stake Ethereum 2.0 coming out. I like ICP, we're not holding that one. But then the other play I really like is Pancake Swap. This is a DeFi exchange built on the Binance smart contract. It pays out this massive 70% staking reward per year. And it's trading at a great discount from its high. So I love that position too. So those are the positions we hold at Rebel Dividends Inc. If you do want to let me manage your crypto positions for you, reach out and we can schedule a call. But otherwise, with Portfolio Builder, we're betting big on the main two ones, which are again, Bitcoin and Ethereum. Bitcoin's main claim to fame is its deflationary 21 million. Proof of work's a much more secure network. Ethereum is switching to proof of stake, which is much less, I would say it's not proven to be highly secure relative to proof of work. And so Ethereum really needs a lot of software to be developed on top of its platform to grow and potentially outpace Bitcoin, but it's inflationary in nature. So I like owning both of them. Absolutely makes a lot of sense. And here we're looking at the recent moves. You can see, let me go to a daily chart. Okay, so since this point in time, so since the 20th, and this is really what we have over at our Rebel Dividends, just giving you a little bit of a feel for how each asset's performing. In my newsletter to Rebel Dividend, I was anticipating we'd see Bitcoin move higher first, Ethereum second, and altcoins third. And so we see Bitcoin now at 47%, Polkadot having some great news up 45, Polygon 29, Ethereum 27, Solana 17, Pancake Swap 3.5, Cardano flat. So we are seeing that trend currently. Now, that means probably Bitcoin will continue to lead the way. It's got to break into a new high. After that, I'd expect your altcoins to start to catch up. Eddie says, are you looking at gold or silver? I'm happy with the exposure we have in pro to silver and gold and safe alpha. So I don't anticipate any trade alerts on those. I actually think interest rates are going to rise and that we will recover the economy. So that could be problematic for gold, silver, and tech. And arguably, it could be eventually problematic for crypto. So NRGU is important for any portfolio because that's your hedge against interest rates rising. And you can see that's our best performing Rebel Dividend position ×2 with NRGU in the last several weeks. Okay, so we got Vermont. This makes no sense. Record cases. We saw this hit Israel, came back down. We've now got Singapore, same thing. The rate of change in the US is falling, which we are anticipating. It's going to pick back up towards the end of November. So that's when we're going to get worried about this playing a big impact on policy and the economy. So you can see it's really, if last season plays out again this season, the last week of the very end of November is when it really just skyrockets. I'd anticipate that's going to happen again this year. it's the cases so far rocketing up in the UK, not the hospitalizations or deaths, although I guess the deaths did hit a record today. A reminder that, hey, even in India without any medicine, it went, it left, it does its job. There's really nothing we can do about it. This should be the last winter. This is going to really be something we cover in our webinars, hopefully. As far as timing NRGU, we definitely want to see ExxonMobil get towards its highs, probably break into new high, and then we probably call it start reducing exposure. So we still got a long ways up. It's only at 63. Its high in 2014 was 104, and we were pumping some pretty expensive oil at that time. Okay, here's a chart comparing interest rates to the price of oil, and we can see these are in stark disagreement. Typically, they track one another very carefully, but the Fed buying bonds has suppressed rates, and so if they're going to taper, I would believe rates rise until it becomes a problem for the economy. So I think we're perfectly positioned for tapering with no changes. We're not going to see a stock crash. We're going to see a bond sell off, probably some pain for tech, but we're hedged against that with NRGU. So I'm not worried about tapering so much. Some commodity futures, copper had a huge leap higher in the last few days. We have seen natural gas pull back, but it's just at these ridiculous levels. Lumber futures are starting to get a big bid once again after having gone parabolic. So the inflation problem remains intact. Baltic dry index, as we were talking about, we're seeing a little cooling off on shipping times and costs, but nothing too dramatic. Here's a look at bonds. I believe there's a risk bonds go lower until stimulus passes. The second it passes, I believe is going to rocket up and likely hit a high in the first quarter of 2023. And then we're going to want to buy up bonds aggressively and predict that the Fed's going to tighten monetary policy to fight off inflation after midterms. Gold copper ratio is a great way to predict rates. This will update with this jumping a bit. So right now this has been predicting flat rates. Second that stimulus comes through, I'm confident this will be predicting higher rates really quickly. The bond markets we track are the TLT for the US government, long end interest rates, and then the junk bond market with J and K, and the investment grade markets with LQD. So no big moves either direction. It's not telling us anything is problematic here. We're not going to be worried about the quantity of debt being issued by Janet Yellen in this chart until reverse repo starts to fall. McConnell gave them an extra $500 billion to buy them some time to pass some stimulus. And I guess that will run out December 4th. So that was a little sooner than I had thought. Okay, the labor data was frightening last month. Probably not going to be very good this month. So I think tapering may not even occur right away. In November, someone's been leaking trading history of Fed folks threatening their positions. Maybe this is pressure to not taper. So very interesting to see all the data leaking on these guys. Here's the core inflation rate. I thought it would either be flat or down. So it was flat. I do believe it'll start to rise again. So the pressure to taper and raise interest rates only going to grow. And until they want to act on that, we got to be hedging against inflation with NRGU. So as you know, we're hedged very well for that. Bank credit, big jump. Banks are lending, very good for how we're positioned. Credit cards are growing their balances, exactly how we're positioned. Retail sales grew the last 2 months, so the fear of a crash in the economy is not realistic right now. Probably reverse repo falling would tell us problems. Here's a look at consumer spending, a brand new high, just skyrocketing up, jumping $400 billion. Job openings did fall, but we also had record quits. So we'll just see when these jobs come back online. Producer prices continue to grow. This will compress margins on corporations or force them to increase prices. So this inflationary play is really still intact for NRGU. A little bit of a drop in jobless claims. Will be more impressive if this goes sub 200,000. Wages are rising, nowhere near the inflation rate though. Labor force participation rate. This would be big if it were to rise. So we can see during Trump's term, it went from 62 to 63 and a half. The lockdowns shrink it to 60. In the last year, we've seen it trade as low as 61.40, print as low as 61.40, as high as 61.70. The last print actually had this falling. So it's really just flat. Now, big picture is if you're going to get 70s like inflation, you need rising wages and more people working to have sustainable inflation for decades. And since 1997, the amount of Americans working has been falling off a cliff, except for these 4 years. So we'll see if they can get this gap filled. A lot of people just don't want to return to work. They're going to have an early retirement. They've made so much with their stock account. They can just be nimble and retire. Balance of trade hit a new low in the latest print. This is bullish for our positioning, bad for the dollar. No big crash in income, even though so many people are losing benefits. We'll keep a close eye on that. Some canaries in the coal mine would be Apple crashing. It's not. Tesla crashing. It's not. Getting ready to hit a new high potentially. ARK funds, again, underperforming, but not crashing. Tencent out of China, stabilizing, getting ready to potentially start heading towards recent highs. Huge opportunity in that with EDC. Alibaba, having a nice bid ever since the headline out of Berkshire Hathaway, Charlie Munger doubling down. Samsung stabilizing, so they've been hit probably by the chip shortage. I'm imagining Toyota staying strong. So all these big giant corporations that we're worried about are not showing pain. China's PMI is jumping after going below 50, showing contraction. European PMIs remain way above 50 at 56. Chinese imports hit a new record high in the latest print, as well as exports. Just look off the coast of California to guess whether or not we're going to have big sales. Okay, we did review that. China says there's no inflation. Yeah, we know that's not true. The Fed, despite talking about tapering, continues to grow its balance sheet. And this has been highly correlated to interest rates remaining low and stock prices going up, enabling government to borrow more money each year, which is really the key to everything, is the deficit spending. Okay, Europe's still printing. Bank of England has raised some interest rates. A few other small central banks are starting to raise interest rates. Japan has stopped printing. So very good. Let's hit the news headlines and then we can look at exact setups. Okay, Mongo says, what about semiconductors? Taiwan semiconductors. So you have exposure to TSM with EDC, leverage ×3. So I would definitely recommend you follow Pro if you want exposure to Taiwan. Yeah, so South Korea, Taiwan, India, China, you get lots of great stuff with EDC, and that's going to be one of your top, I think, top 5 positions over there is TSM. Okay, Goldman Sachs slashes its forecast of Build Back Better, now sees 2 trillion. That's what I've been expecting. So McConnell, I think, is full of crap and really a Democrat, but he's the one who gave them this 2-month extension and $500 billion more of spending to buy some time. So we'll see whether they extend it again if they can't get the deal passed by December 3rd. The GDP is expected. The Atlanta Fed was predicting we're going to have like 5% GDP. They have lowered that to 0.5. So it just shows you how desperate the US economy does need more stimulus. Otherwise, we will go into a contraction without question. Here's an interesting chart just looking at commodities relative to balance sheets. Main trend I see is when the balance sheet's growing, commodities do really well. But the second the balance sheet flatlines or goes down, commodities get crushed. So tapering will probably, once the tapering ends, we probably want to most likely reduce exposure to NRGU once it actually stops, but not until then. So right now, that's anticipated to be mid next year, assuming they can really pull that off. Here's Chinese coal futures just skyrocketing. They're telling everyone to secure supplies at all costs, and now they're saying they're going to arrest people for colluding in it, driving the price up. So just funny to see. Now this is interesting tweet. Bitcoin futures ETF demand surges during US trading premiere. Wait until people see how this really performs. USO is down 90% since the inception, while WTI physical price is up 20% because they're dealing with contango and backwardation and all sorts of middlemen who get their hands on the pie. That's why we're not running into the futures product for Bitcoin. Here's the premiums right now on grayscale products. So you get Bitcoin at a 20% discount compared to what they actually own. Ethereum at 10. We're not playing the other little ones they have. If you want some Ethereum Classic, you can get it off 42%. I'm not a big fan of Ethereum Classic. I think the only one still helping that project out is actually the founder of Cardano, who's about ready to throw in the towel. China's freaking out about an energy crunch coming into winter. So is Europe, so is US. New strain coming out of the UK, spreading faster. This is looking at profit margins at 14.5%, record profit margins. Are these going to become compressed as input costs rise and they can't pass the cost to the consumer whose wages are not keeping up with inflation? Eventually, probably, but maybe not right now. Facebook is pushing a stable coin and a wallet, partnering with Coinbase. This is the most pessimistic the market's been on bonds, apparently for 2 decades, which we agree with. This was an interesting note showing the number of wallets with over 10,000 Bitcoin has dropped from 105 to 80 as the price has skyrocketed to 60K. Now, are they taking profits and buying Ethereum and altcoins, or are they cashing out? I don't have any good data on that, but I would presume they're buying altcoins. Some betting odds on the next election. We got Joe Biden for the win, Donald Trump in second, Kamala Harris, Ron DeSantis, Mike Pence And then if you go down far enough, you got Dwayne The Rock Johnson in 9th spot. So long ways out before we got to worry about that. Janet Yellen's coming in to talk some policy with moderate lawmakers. New headline today, and progressives at 2 different times. Now it makes more sense why China kicked out Bitcoin. They saw the energy crunch coming and realized they need every ounce of energy possible to operate their economy. This is a chart showing a basket of commodities breaking through a channel and what this could do with interest rates, make them rise. This fellow has a price target of massive run up to 80,000 by, well, let's see, he's predicting 147,000 by the end of the year, sell off to 97, and then rocket up to 231 and then crash. So it's always funny to see people who like to use Fibonacci levels to predict prices. But, you know, it is also remarkable how often those can play out with the right fundamental forces behind them. This has just been going viral. The news talking about the efficacy of the medicine started off at 100%, then it dropped to 95, and then the next thing you know, they're printing stuff that says as low as 33%. So just hysterical. Anyways, we were predicting that was the case for several months now, and it absolutely is true. Lots of people are defying the mandates. This is going to be very, very bad on labor, which is good for the way we're positioned. Okay, good. That does take us back quite some time. All right, let's go to the little pitch to upgrade, and then we'll go into asset allocation. All right, guys, so if you're expired or you're watching this on YouTube, this is where your video ends. You're not a paid member. You're not going to get the exact formula for success. So if you want to get that, call Dean at 505-610-1334. You can do an annual membership, which is great, or you can buy a lifetime membership and you'll get a special report where I reveal about 7 cryptocurrency plays that are not even listed on exchanges that I highly recommend you put at least a few $100, a few $1,000 behind, because they're likely going to go up 10 times or more in the next year if Cardano, Solana, and Polkadot can give Ethereum a run for their money. And it's looking like at least one of those 3 will give them a run for their money. Specifically, Cardano absolutely seems to be ready to do that. Right now, they just got their smart contracts, so software is being developed right this second. It's only weeks old, so I definitely recommend that. And then Solana is getting pushed by the tech giants, the VC tech giants who brought you PayPal, Twitter, Facebook, everything. Okay, these are some of the richest people in the world pushing Solana. And absolutely, I do think they're going to give Ethereum a run for their money. So you can start to invest in some of the software applications being designed on the operating system of Solana and Cardano right now before everyone else gets it in the exchanges. So the ones I like right now are essentially what was successful for Ethereum so far, which is Uniswap, a decentralized exchange. So that's really the core technology these guys are going to create. And then lots of other applications can be designed after that. But you got to get the basics running first. Okay, very good. So I'm going to go ahead and hop into paid member content only now.